As a minor accommodation to taxpayers, the central government has extended the tax due date for filing income tax returns by 2 months, which means all assessees will now have until the 30th of September to file their returns, which gives all of us a little over a month from now to get and verify our Form 16, our capital gain statements, interest certificates, TDS, and other essentials. It is often the small things that often gets missed out. So in this video, we shall discuss 14 most common mistakes made by assessees when filing their income tax returns. The understanding of these mistakes and the avoidance of it in the future will certainly help you avoid tax demands, penalties, audits, and in extreme cases, even the attachment of one's bank account. Tax filing is important, and it is important to get it right. With that being said, let's begin. Missing the tax filing deadline is not ideal, and any delays on your part can and probably will lead to a number of unwanted consequences, such as 1. A penalty might be applied and this can go up to 10,000 rupees. 2. Except for house property losses, you will not be allowed to set off any other losses against future gains. So if you are into mutual funds, shares, etc., this can be mighty unprofitable for you. Thirdly, an interest of 1% per month will be charged until you pay your taxes. And finally, you won't get any refunds on excess tax paid until you file your returns. So be smart, be punctual, and ensure that you have marked your calendar in advance at least 3 weeks before the deadline. If there is something worse than delaying your returns, it is not filing it in the first place. By existing rules, the tax department can launch legal proceedings against individuals who have not filed their income tax returns. As you might have imagined, the consequences of this can be very severe, including the payment of interest from the due date until one files the ITR, a minimum penalty of 50% for the tax that has been avoided, and even worse, the tax laws allow for incarceration, which can range from a minimum of 3 years to a maximum of 7 years in prison. So interest, penalty, and jail time. One of the most common mistakes made when filing returns is to use the incorrect form, which in turn renders the filing as defective and gets rejected by the income tax department. Now, the ITR forms we need to use are based on different sources or combination of incomes. For example, if one has only salary income, then ITR 1 will do the job. But if that same person has salary income and also has some capital gains, then he or she needs to use ITR 2. And if any individual has business income, then 1 and 2 will not work, and it is ITR 3 that needs to be filed. This can get a bit confusing at first, but the good news is that most portals that offer a DIY or an assisted filing service have developed the necessary workflows that will help you determine which form to use. So do take advantage of these tax filing platforms or consult your tax advisor, but be doubly sure of which form you need to use when filing your returns. The phrase silly mistake is something that is very compatible to a mathematics test paper that we would have all given in school. The income tax adaptation of this includes mistakes as silly as quoting the incorrect PAN, or writing the wrong email ID or date of birth, or entering the incorrect bank account or IFSC code. And while these silly errors might seem harmless, but in reality they can have some really undesirable consequences. For instance, if you were to quote a wrong PAN number, your returns will be rejected by the IT department, which can then open you up to penalties, interest, and tax audits. Similarly, if the right bank particulars are not there, then you'll face much delays in receiving any tax refunds that you might be entitled to. And even a simple act of providing a working phone number and an email address is important, because the tax department often dispenses important information via SMSs and emails. So take that extra minute and make sure your tax returns have the correct personal information at all times. Many taxpayers get confused between an assessment year and a financial year. Quite simply, a financial year is the year or time period within which the income is earned. For instance, when we file our returns this month or the next month, we are actually filing it towards the income we earned between the 1st of April 2020 and the 31st of March 2021. This period from April to March is the financial year, which in this case is the year 2020-21. And an assessment year is the year that follows the financial year and is the period in which the tax returns are filed. Now, since we are filing the returns in August or September of 2021, the assessment year is 2021-22. So always remember, the assessment year is always ahead of the financial year, and when you file your returns now, don't forget to choose the assessment year as 2021-2022. Many of us have multiple bank accounts. However, a large number of people ignore mentioning all their bank accounts. This is against the income tax rules, which requires that all assessees should disclose all the bank accounts that they have, that is, their domestic and their foreign bank accounts. This requirement was introduced just a few years back, and the primary motivation here was to check the growth in money laundering activities. The tax laws also require that in addition to disclosing all new accounts open, the assessee also needs to reveal all bank accounts that were closed during the financial year as well. If there is one area an individual has to be most careful of, it is the reporting of all sources of income to the tax authorities, with all being the operative word. Now, most individuals have multiple sources of income. The salary income or business income is the primary one, but then there are other incomes like any rent that you might be receiving, interest from your fixed deposits, dividends from shares, capital gains from the purchase and sale of assets, etc. All these incomes need to be mentioned in your tax returns, irrespective of whether they are taxable or exempt from taxes. Which means if you have received interest from tax-free bonds, that too needs to be declared in your IT returns, although no tax will be calculated or paid on it. Further, if you have changed jobs recently, ensure that you report the income from all employers in the financial period, that is the present and the previous employers. On the whole, be transparent about all the incomes that you have earned in your tax filing, and if you're not certain about any particular point, then do consult a tax advisor. The point on capital gains and capital losses is important. This is often something that gets missed out, especially by young tax filers, and can have serious consequences at the time of a tax audit. Because per the income tax laws, any and all capital gains or losses have to be compulsorily disclosed in one's income tax filing. Well, this was a bit difficult to catch on to in the past. With more and more systems getting integrated with one another, tax authorities are finding it a lot easier to understand where the gaps are, including on a retrospective basis. So in case you have been ignoring this non-disclosure of capital gains in the past, it is highly recommended for you to consult your tax advisor and seek his suggestions on the next course of action. From a tax filer's standpoint, the calculation of capital gains, especially in the case of mutual funds and shares, is quite easy now with platforms like ETMONEY collating, aggregating and presenting one's capital gains information in an easy readable format. The tax laws require that any investment income earned by a minor have to be clubbed with the parent's income when computing the taxable income. In other words, the parent is taxed as if the child's investment income were the parent's own income. In fact, taxation of minors has some very specific conditions, so a little research on your part will definitely come handy. But here's one point we found particularly interesting. Per the tax laws, when a child earns income by way of any work or activity for which he or she uses any special talent or knowledge, then that minor is required to file an income tax return. For example, this can include income earned as a junior Indian Idol or a junior Master Chef, or in what is becoming very common nowadays, a minor earning from his or her own YouTube channel. So if you have a child who is either an earning member of the family or has income from investments in his or her name, then don't forget to take the necessary actions from a tax filing perspective. Many SSEs often omit to record the interest from savings accounts, assuming there is no tax in them, which is not correct. Per the current tax laws, any interest earned from your savings accounts above 10,000 rupees is taxable, and during the course of filing, the SSE will need to compute and disclose the entire interest amount. Also note that this amount covers the interest from your savings accounts across banks, cooperative banks, and also your post office savings accounts, which means this deduction of 10,000 rupees is an aggregate amount and is not a deduction per bank or per account. So do ensure that you access the interest certificate, which is generally available in your bank's net banking platform, or else you can manually calculate the interest, which is normally credited once a quarter. The one thing that every tax expert advises is, please verify your Form 26AS before filing your ITR. This Form 26AS is sort of a passbook that includes different kinds of income details, the TDS, the self-assessment tax, and any advance tax paid by an individual. It also contains any tax credits that are applicable to you, which can then be used to obtain tax refunds or can be set off against additional tax payments. Now, it is quite possible that there might be some mismatches in your calculations versus what is there in the Form 26AS, which is why it is highly recommended for all individuals and especially salaried individuals to cross-verify the Form 26AS details with the employer issued Form 16. At the time of filing your income tax returns, always make it a point to pre-validate your bank account. This comes really handy in cases where you are entitled to a tax refund. Now, in case your bank account is not verified, the income tax department will not be able to credit your tax refund, as the current practice is to directly credit the refunds to the taxpayer's bank account. So if you haven't done that yet, do verify your bank account, which can be easily done online via the tax department's website. Here is a mistake I once made. I put in a day's effort to finish all my tax forms but forgot to verify my tax returns. It was only when I received a notice from the tax department that I realized my mistake, which costed me a lot of time and money to rectify. So remember, a tax filing process is incomplete until one verifies the tax return, which needs to be done within 120 days of completing the forms. This verification can be done in many ways, including sending a signed physical copy to the tax authority's central processing center. You may also e-verify using your Aadhaar, verify using your bank's net banking platform, which is what I normally do. And there are a few more ways of doing this, but remember the process: compute, disclose, complete, and then verify. The tax authorities allow SSEs to rectify mistakes made in the original returns by filing a revised IT return. These mistakes can happen due to accidental omissions, wrongful deductions, or even incorrect disclosures, but thankfully a revised ITR can fix all these up. Now, while there is a provision to revise an ITR belatedly, it is always advisable to file a revised return before the end of the assessment year or before the completion of the assessment by the tax department. Also, while there is no limit on the number of times one can revise the returns, we suggest you use it sparingly, as multiple revisions could lead to a more detailed scrutiny by the department. But all said and done, you yourself revising the returns is a lot better than the tax authorities unearthing your mistakes, which can then be treated as concealment of income, leading to penalty and interest. And this brings us to the 14 tax filing mistakes that every assessee should avoid. I sure hope you found the contents of this video useful and going forward will use them as a checklist. Additionally, please note that income tax rules keep changing from time to time and the interpretation of some laws might be different from what we think they are. In light of the same, we request you to consult a tax advisor in case of any confusion, as they would be in a better position to explain the tax nuances which may be different for different individuals. However, I do hope you enjoyed this presentation. Do subscribe to the ETMONEY YouTube channel, do like this video and also share it with your friends and family over WhatsApp, Facebook and Twitter. Thank you for your time and I look forward to catching up with you next week with another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.